Look at this. You did that, and it must have saved you when it came time.
It saved both of us, because I find it ironic, Bill, that when you're intimate with somebody and you've had children with them, when that business arrangement is over with, you want to tear each other apart.
Right.
If that makes sense. To me, it's just as important how you act after the relationship as you do during the relationship. Get educated. Educate, educate, educate. Learn the tools to get you to your goals. The second thing is, first, get your own personal financial life in order. If you have somebody that's not on the same team, you need to confront them and get them on the same team. That would be the second thing. The third thing, get your health together. Because once you reach financial independence, you want the health there to enjoy it.
Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Jackie, we're back this week with the wealthy custodian, our friend and yours, Jeff York. We hope you enjoyed the first episode. This will be part 2, right?
Yeah, look, we got so much great stuff from the first part, but man, if he's dropping gems like that, we are all ears and we want to listen. And I think most of our audience will definitely appreciate so many of the tips that he's sharing with us. So we got another episode of Jeff York, just again, dropping all the great gems that he's sharing with us. So listen in. So 457 is so you can have a 457 and a 403B at the same time and contribute to the max. Now, 457, is that the one where once you separate from service, you can take withdrawals without a penalty?
10% penalty. Yeah, you remember a school district.
That's a superpower right there. We love.
Yeah, but 99% of the people don't have that superpower.
Right.
My first wife and I, we had the superpower because she wasn't providing economic outpatient care to her 30-something kids at the time. I'll use that from the Millionaire Next Door book that I read back in the 90s.
Yeah.
So back what I was doing with extreme paychecking is 08, 09, and 10, I'm dumping massive amounts of money in there. Unfortunately, our relationship ended, and I'll never forget my mom saying to me, she goes, well, how much are the attorneys going to make? I said, no, Mom, we had a prenuptial.
You had a prenup. What prompted you?
She came with money. First wife came with money. Second wife came with money.
Wow.
I'm not putting it down. Money attracts money. I'm not being judgmental. They came with money.
Didn't we just go to economy?
We did.
One of the Sentinel lectures there was all about prenups.
Yep.
And we're going to have to do an episode on this now. I didn't have the foresight, but look at this. You did that, and it must have saved you when it came time.
It saved both of us, because I find it ironic, Bill, that when you're intimate with somebody and you've had children with them, when that business arrangement is over with, you want to tear each other apart.
Right.
If that makes sense. To me, it's just as important how you act after the relationship as you do during the relationship. So I'll give you a little epilogue. So that relationship is ending. And what's ironic is I got to clean her classroom for the next 10 years.
I was wondering.
Not the next 10 years, excuse me, the next 3 years after that.
I was wondering if you met them at school. Like, did she just like the way you were swinging that broom or something?
I had known her for a very long time, and her kids had gone through my school. So here we're in 2010. I'm back living with my dad, right? My dad says, son, you need to go buy a house. I go buy the house, so I'll go back to her. I clean her room for the next 3 years. She leaves at age 60 because that's what we planned to do, right?
Mm-hmm.
And one day I'm cleaning the cafeteria tables, and she's kind of a private person. Comes up to me and she goes, Jeff, I want to thank you for getting me to retirement. And I said, blah, blah, blah. I said, I didn't do anything. I said, I just opened the doors. You walked in. I said, you did it yourself. And she left at 60 and only taught for 18 years.
Yeah, so no animosity or anything like that. You still see her?
I have not seen her.
Okay. But you saw her before she retired at the school.
Yeah, she worked at my school for 3 more years.
Gotcha,
I cleaned her classroom every day.
How did the prenup work in divorce? Did you basically keep all your own assets?
Yeah, whatever we brought in, we kept, and whatever we built together stayed.
Did you split it down the middle?
Whatever it was. It was that simple. She kept her house. She kept her STRS. She kept her PERS. She kept her 403B. She kept her IRA. She kept her Roth. She kept everything. Because generally when couples start out together, it would have been different if her and I started out at age 22 together, where we don't have a rock to throw it out the window. It would have been different. But that's a late life. I looked at it as it's an economic alliance. I learned that at Shasta College. When you get with any partner, regardless if you got a contract or a prenup, it was very simple. It was done. I was able to go buy a house. Because generally when people break apart, unfortunately, the more fair side, feminine side takes it in the back end, because generally in our society, men are the ones that are making most of the money. And women generally have a step down in their social economic standing. Not always, but with her, she was an anomaly because I treated it as a business, how we did it.
Absolutely.
So she got to retire. I got to go buy a house. The janitor making $34,000 a year goes buy a $170,000 house in a slightly upscale neighborhood of Redding, California. That's my stat. That's what I'm driving at. So nobody's impoverishing anyone.
Right.
So
because there's life after divorce. I mean, it can be devastating, but it doesn't always have to be. The prenup, like you said, that sounds like that had something to do with it.
Oh,
and
yeah.
It was, yeah.
I was sad. I was upset, but I've learned in life, everything is always moving in and out of form. Everything. Yeah. There's nothing ever bad ever happens. It's just change. Everything. That's how I handled my mom passing, my dad passing. Whatever. Everything's always going from organization to disorganization.
Yeah. Did you swear off marriage after this?
I did, number 2.
Tell us about that.
She came from money. She came from money, and I have a lot of respect for Jewish people. She came from a high social economic side of the Jewish community from Long Island. Kind of a long, crazy story how you go from Long Island to Redding, California. And she inherited quite a large sum that was kind of one podcaster calls it the hodgepodge. I call it the potpourri. And I got it together and got all this money all consolidated down to 4 counts at Vanguard with Vanguard's help. And one night she comes home from her 6-figure job, and that's a pretty high income in Redding because she's over a couple of departments for the state. And she goes, I'm just really stressed. And I said, well, do you want to get out of there? She goes, yep. I go, start doing these behaviors. In the state of California, you have a 401k because you have a private letter ruling and a 457 because they're considered governmental. That's how schools can have a 457 and a 403B because I learned we're bitactual. A school, if I remember right, is a 5013C, and we're also a governmental organization as well. So that's how we can run the 2 programs. That's how the state of California. So she started shoveling, oh my gosh, how outrageous amount. Because one time she came in with her paycheck, I think her take home was like $1,800 a month and had like a $7,000 a month pay rate. And she goes, I'm poor. I go, no, you're not. I go, you're just tax efficient.
Yeah.
Because she didn't have a lot of time in the pension. She was in CalPERS. She got in late, like at 50. So we were using the low income custodian that has everything under together as the platform for her to build her wealth off of, because I'm shielding her from costs of housing, just like my first wife shielded me.
So for the second wife, did she make you sign a prenup, or did you have a prenup?
No, she refused to do a prenup.
Wow. Did you ask?
Yes. And she did not want to do it. She did not want to do it. And we only made it 18 months. And I'm the one that had to call that one off. I did it. And 85% of the time, it's the women that go get the divorce. But she wasn't going to, my second wife, she has a lot of issues. I have a lot of respect for her, that wasn't going to do anything because she walked out with more money than she came into.
Gotcha.
I think during our tenure together, she probably left with about $250,000 to $300,000 more than when she came into.
And her finances well organized because of you.
Exactly. She had the college degree and could look and play the part of any white collar worker around, but there was some other issues. And I'm sure her next husband that she married soon after me, because she marketed herself very well on the internet, is very happy that she came with quite a dowry. So anybody that's ever been in my life, you'll see a pattern. They're always better off financially. I will toot my horn on that one, whatever they do. But I have no animosity against them. I kept my house. She moved on to someone else. She took hers. I filed the paperwork. It wasn't really a divorce. It's called a dissolution of marriage. I had to do the paperwork. I'm not good at paperwork, but I always seem to get through it. And that one, I'm sorry it ended, but everybody financially left better off. Does that make sense?
Yeah, I mean, awesome. So that makes sense. So after that second one, you swore off marriage, right?
Yeah, I'm done.
But you didn't have a number 3?
No, I've never had a number 3. I did date someone recently. I don't mean to be biased, that she is what they call a nurturer by the money type, I just learned, or she gave everything away. And she's bouncing on 60 with no resources. And I'll leave it at that. And I now know the next one, that if one wants to even want to get involved with my lifestyle, heaven forbid her, they got to come with some resources. It's called financially unequally yoked, not to take a term from my Christian friends. Yeah. It really makes it easier if you both come with resources. Yeah. And I hate to say that.
Awesome. So I appreciate you being so open about that, but I feel like divorce, if you ask anybody, what's the biggest decisions you can make financial, they'll say, marry the right spouse. So, okay, so if we made the mistake and we didn't marry the right spouse, does that mean it's all over? No, it's not. I'm divorced. I reached financial independence. I stepped away from my job and I'm doing this. You were divorced twice. You got out of that okay. You kept your finances intact and you graduated and reached financial independence. So there is life after divorce.
Right. But I'm going to just warn people, as you build wealth, you're going to be separating yourself from a vast majority of the population. Yeah. And I'm not being discriminatory, but you have to, I call that a wealth penalty, because you're starting to be around other people at different social mobility levels, because money always attracts money. One podcaster calls it has currency. It has a flow to it. You and I are together because of our wealth. Right. Correct, right. Jackie? And Bill as well.
Yes. And our interest in financial literacy and our passion for it, really. So, and Bill, that's sort of why it was so important for us to build the community and the Facebook group, so that they didn't feel alone, that they would have a place to go where they could talk about certain things that maybe they didn't have anyone else in their real life that they could have these type of discussions with.
This is a real treat for me, because I don't have much of a money tribe, if that makes sense. And I'm sure your listeners are going, when are we going to get to Jeff's accounts and where are they at? So let's go do that.
Okay, let's do that.
We're already rocking on an hour and a half already.
I was just about to go there.
We digress.
No, our audience frequently asks, is there a magic button? Is there a way to escalate this path? And they're going to want to know, what did you do? What did you invest in? And it certainly sounds like you were aggressive, probably 100% stock. You seem to have that kind of limbic system, much like the guy that free climbed, was it Half Moon or something?
Yeah, Half Dome, yeah.
You seem to have the same mentality. So tell me how you did it. What did you do?
What gives me a bit of an immunity that most people don't have is I have CalPERS pension. And I did lots of cultural behaviors to boost that pension up. So that's my bedrock. Someday maybe you'll have me back on where I'll talk about the spigot method in the decumulation phase. I haven't heard anyone talk about a spigot method. But the first thing I did is I did everything I could to boost that pension up. Okay. And we could spend 3 hours on that. So when I left the school district, even though my pay rate was very low, I got about 82% of my pre-tax income. I've never lived on all of my income in my life. So when I left the district, I get about $37,000 a year pre-tax. I got to pay tax on it from my pension. And then what I did was, during this work years, I didn't upscale my lifestyle. So I was able to put a lot of money into my 403b7 that last year.
So Jeff, when you say 403b7, you mean your 403b and your 457, and you just combining those terms?
Well, I did put some money in a 457, and I've been told you can't do this. When I took money out of my 457 and rolled it into my 403b7, I've been told by the higher ups, you can't do that. I did it. Maybe there wasn't a watch person watching me.
So be sure to check the latest IRS code to make sure you get that right.
That was years ago. That was like 12 years ago. I moved it all into the Vanguard account. And then basically what I did is I just did broad asset classes in my 403b7.
Yeah, I was about to say, so what were you investing in? Was it just stock index funds?
In the beginning, it was a targeted dated fund. I didn't have much in the account. I didn't have much. And then when I would take money out of those annuities I'd been putting money in, there was already $70,000 or $80,000 in there. When am I taking it out and transferring it into the market? 07, 08, 09, 10. It's like a surfer getting on a surfboard.
Yeah.
I'm catching the wave, right?
Yeah, yeah.
And most of my wealth has been generated from 08 and 09.
Right. So it was target date retirement fund.
I started out with that, and as my financial literacy, it's more complex. Most financial planners would get upset with me. I got 17 different funds. I chop it up into little asset classes.
Like small cap, large cap.
I'm overweighted. I did the Paul Merriman thing, not to give him a plug. His Live It Up Without Outliving Your Money books and these DVDs from the early 2000s. It's overweighted to small cap. It's overweighted to value. Yes, I know it hasn't had its day in the sun, but when 2020 came, it had its day in the sun. I'm overweighted to outside our country. My portfolio set up 50-50.
International.
50%. Yep. Most people are biased to 10 or 20% international because a lot of the economic activities out of there. Today, I just checked it. The IRA just went over 622,000.
Wow. So Jeff, is all of this, they're low-cost Vanguard funds, and it's mostly stocks? Like, do you have anything in bonds?
Yeah, there's about 24% that's in that. And then this year, last summer was kind of another big paradigm shift when I got the money out of my employer plan. 5 weeks. Don't want to even go into what it took to get the money out of there.
Okay.
It got over to Vanguard. Once it kind of seasoned there, I converted it to ETFs. To me, an ETF is like using a standard transmission in a car. You got to know about bid-ask spreads. You got to know about market orders, limit orders, marketable limit orders. You got to have a little bit of sophistication. So about, I'd say 70 to 80% of my portfolio is ETFs now in the IRA.
You may have heard of a new financial planning platform called Nectarine. It's at hellonectarine.com. And this is put out by our friend Jeremy Schneider, who runs the famous Personal Finance Club. If you're on Instagram, you have seen his sketches, and he is awesome. He is well respected. He knows what he's doing. And one of the big questions that he never had a good answer to was, how do I find a good financial planner that is flat fee advice only? He didn't have an answer. So you know what he did as an entrepreneur? He created a platform. And that platform is Nectarine, where it's $150 flat fee for a 1-hour session. And this is with vetted advice-only planners. Most are CFPs, which stands for Certified Financial Planners, or other credentialed and licensed professionals. That's an important nuance. And again, this is brought to you by Personal Finance Club. I myself, as a nerd, went back to get my certified financial planner credential, and I know how valuable this credential is. And Jeremy wanted to make sure that he was only providing you with the best. So go to hellonectarine.com, and for a flat fee of $150 per hour, you get access to an advice-only financial planner. Check it out. So Jeff, you said you have a lot of different funds. Do you think it's fine to, if someone wanted to, like, for instance, do the Simple Path to Wealth, J.L. Collins, just have one total stock market index fund, like a VTI or something like that? Do you think that people are fine with that? Do they need all these different funds?
I have one person I've been mentoring. He does the 4-fund solution.
Okay. And that's the Paul Merriman. We had him on the show.
It's not Paul. This is the 4 fund. I don't know what his 4 funds.
Oh, is it the Vanguard 4 funds, like the Bogleheads 4 fund?
Yeah, one is total international.
Okay.
There's international stock, domestic bond, and then the total international 4 funds. You can do that.
Gotcha.
That's fine.
Okay.
You don't have to be as sophisticated. You don't have to be as sophisticated as me.
Yeah, and have you read The Simple Path to Wealth, J.L. Collins?
Yeah, yeah.
Yeah, so he talks about the one, just put total stock market and a bond. So, okay, so no matter what, they're just low cost funds where the fees are very low.
Yeah, I think my expense ratio across the whole platform on the IRA is like around 10 basis points or 0.1%.
Yeah.
Very low cost, and there's no advisor fees. I'm doing all that. I know your audience is yelling, Roth conversions, your low income Roth conversions.
Yeah.
I'm not going to go into Roth because I think the government's going to change the rules on the family someday. That we'll leave it at that. Nothing is free forever. That's my take.
Well, not only that, because you're in a lower income. I mean, when you take the money directly out of your traditional money, you're probably being in such a low tax bracket. No.
I've already projected I'll be at about 130,000 when I tap Social Security, the pension.
Seriously?
Yeah. Think about it.
Well, I was about to say, have you turned on your pension, and how much do you expect to get per month from your pension?
I take on just under $2,900 a month. I keep my income low because I'm on Covered California, and I'm bagging $15,000 worth of advanced premium tax credits.
Oh, yeah. So that's the ACA, the Affordable Care Act, the exchange. Okay.
Right. And I don't want your audience to think I'm doing something bad, but I'm on a high deductible health plan that the first 7,000, I gotta, if I go see the doc, I go see Bill or emergency, I better cough up $5,000 ready for him to go. Most people at my income don't have that. So I keep it artificially depressed.
Right. And I'm a big proponent of the HSA, and I have one that has grown pretty big. I think we might have talked about this.
Yeah, yours is bigger than mine now.
I'm closing in on $200,000 in my HSA, and I get health insurance from the Ohio Exchange, the ACA, and I'm on a traditional plan though. I've been on a traditional plan since 2020, so the HSA is just growing without me putting any new money.
You guys are hilarious when it's like you're out there with the measuring sticks. You said yours is bigger than mine.
Well, she had higher income, plus she had a family, and I didn't do mine from 2010. Till 2019, I didn't do mine because I'm fighting a house. I'm running a house now.
Right.
So, okay, so back to my HSA is 68,000 now. And I had mine in 2004. I was one of the first people to open them.
Yeah. So you got me beat on that one because my company started offering them in 2008. But anyway, we digress. We're going to have a whole show on HSAs, right, Bill?
Yeah, we'll have to do that.
There's one more thing I want to go back to. And you're speaking my language with things like international. I don't partition it into multiple funds like Paul Merriman says, 10 funds for life. To me, that's just too complicated. I do it where my plan is going to retirement to do it with 2 funds, the total world and then short-term treasuries. And just stay highly invested and just make it easy. And it almost ends up being the same thing. I used to be in small cap and other things. You know what? I had to plan for my wife. I have to make it easy for her. I couldn't do what you're doing because she's not the CFO and she wouldn't get it. As far as withdrawal strategy, the easier I make it, the better it is for her.
That's beautiful.
Yeah, and Jeff, he's not working on number 2. It's been one and the one and only for all this time. So
right. So so the HSA's got about 68,000 in it, and I just funded it for this year because I couldn't pay the house off and fund it all at the same time because that was about $17,000 to do all that. The house is worth about $350,000.
Okay, and you've paid that off, right?
Paid that off. I gave up that 2.39% loan. Shame on me.
Well, it's again about preference.
It's all everybody say, arbitrage it, Jeff. Put money in your Roth. Won't go there. And then, unfortunately, I had an inheritance at the end of 2021, and I was able to actually build out a brokerage account, and that's got about.
Was that your mom?
Yeah, unfortunately.
Yeah, sorry about that.
Yeah, my mom passed, and I had to become an attorney because she did no estate planning, and I had to learn how to take the house to non-probate, long story there. And then fortunately or unfortunately, when Paradise burned down, that whole area on that other side of the valley, every little house with a door and a window shot up in price because supply and demand when Paradise burned down. And there was people wanting that house barely after my mom was gone and got that thing sold. So I was blessed, so I got some inheritance. I got about 80,000 there. So if you add up the mess, I was kind of surprised. Right now, it's 1.1.
Wow, 1.1. So how did it perform since you left your regular job? So what was your net worth at the time that you stepped away in 2020?
And at the end of in 2021, I became a millionaire on my own. I've been a millionaire 3 times in my life. First wife, if you join the assets.
Right.
Second wife, if you join the assets. Third time, Jeff on his own does it.
Yay. Yes,
Because-
that's awesome.
But in 22 happens, my net worth drops down to 950,000.
Right.
Did I freak out? No. PERS keeps sending that check every month. It's that account, right? That's that
Yeah.
steady cash flow, right?
Yeah.
Car keeps running. I keep catching fish. Life goes on.
So, Bill, are you tracking this? So he retired in 2021 and became a millionaire and had $1 million. And now 3 years later in 2024, your net worth is 1.1 million. So that means since you graduated or stepped away from your school job,
Right.
your net worth has increased.
Yeah, because what happened was it was hard for me emotionally to handle it. Here we're in a global pandemic, right?
Yeah.
And I'm becoming wealthy.
Yeah.
Because the people that were given money that generally don't have money, and some of my family members fit that description, they went out and spent it. What do I have? I own assets at Vanguard that own mutual funds that have shares and companies that those people that got their stimulus money are spending them in.
Yeah. And you would have qualified for both of those stimulus checks, or was it 2 or 3?
I got almost $5,000.
Yeah.
What do you think I did with my 5,000?
Oh, I know what you did.
What do you think I did?
I believe you put it either in a brokerage account or you put it in a brokerage account.
No, I bought a lifetime fishing license and threw it to the house.
Oh, I was way off then. I know you love to fish. We're going to talk about that at the end.
No, we don't need to talk about
Look,
fishing.
the thing is, if I ever come to Reading, is that where you live? If I ever come
Yeah.
out that way, will you teach me how to fish?
Yeah, just come when it's cool because you won't like it out here, but we have no humidity, so you'll like that.
Okay. Yeah, I want to learn
Yeah,
from
if you
a
want to
pro.
go fishing, yeah, no problem.
Okay.
So
Yeah.
quick question. You have the pension, your house is free and clear, yet you have 25% in bonds and you have a high tolerance for risk. Why do you do that?
There comes a point, I think it's called the law of diminishing returns. Is it going to change my life that much, Bill? Am I going to go buy the F-250 Ford Raptor truck out in the driveway? That doesn't provide me the dopamine hit. Like a couple of weeks ago, I'm out with one of my fishing mentors. He's a multimillionaire, retired school teacher. You would never know. He fits the one house, one spouse, no kids profile. He goes, don't you want a boat? Don't you want a truck? I said, I used to have a truck. I don't need a boat. I'll put fuel in your boat. He goes, oh, you don't have to. I can fill up my boat. I said, I don't need it. I don't want the responsibility. My dad taught me, he made it to 93. He goes, as the older you get, you'll want things more simpler. That's why the house is paid off. That mortgage company, one of the most satisfying moments in my life was when I got the congratulations letter. I called my homeowner's insurance broker. I said, pull them off. They have no more interest in this place. Pull them off of my homeowner's policy as an interest in it.
You got a congratulations letter? I may have told the story before, but we went to the bank, wrote a big check, paid off our mortgage, and the teller goes, okay, thanks. And it was like a no big deal. There were no fireworks. There was no confetti. There was nothing. It was a normal transaction although it was life-changing for us.
Yeah, I mean, I'm in my 4th month now, and I feel like I've gotten married or I picked up a side gig. I got 30% of my income back. 30% of $2,900 a month is a lot of money because it's such a small amount.
Oh, Jeff, what's your side gig?
My side gig is giving my time to change other people's lives through mentoring, going on pod, speaking to high school students. I trade my time for experiences and I trade my time for health. That's why I go to the gym every day, so I can be healthy. Because it doesn't matter how many zeros in the account. Bill can attest to this because he deals with those clients, that if you don't have your health, it doesn't matter. Health is wealth. I mean, if I don't have my health, how can I jump across rocks out at the dam last night trying to reel in a spotted bass in the dark? If I don't have my balance and I'm not healthy and can see and do those things because I'm a physical kind of person.
Yeah, and we had an episode with Dr. Bobby that people should scroll back to. And did you listen to it?
Oh, yeah. Oh, yeah. He's hitting on all 12 cylinders. I've listened to all of that. Yeah, I totally agree with him. That's why I do yoga every day. Has there been anything on this podcast that surprised you about me or what you've learned?
There've been a few things, although, just that you did it and that you have such a balanced approach to things. Your
Yeah.
optimism is contagious.
It really is. That's why I love talking to him. I'm like, we have to get Jeff on the show. And I think what you're saying about the whole having bonds or whatever, and the question that Bill asked you, you've won the game. And you're like, what do I need more? So I guess I'm curious. I can predict that you will have a pretty big chunk left of your net worth when you pass away at like 100. And let's say you get to 105 and you pass away. What's your plan?
I don't care, Jackie, how long it is. I care about my health span as another podcaster. You know, if I make it to 90 and my health is good and I can still drive my car and see, great. If it's 102 and I can't see and I got someone taking care of me, I don't personally want that. So you're saying, what's the end game for it all?
Yeah.
What is it? What if I am unfortunate and get some type of cancer or whatever, and I have to have long-term care, and I hear us guys don't last very long there, it goes to the local public channel 9. The power of the transmitter. Because when I was a little kid growing up in a rural part of Northern California, I like Channel 9 because I have an intellectual side about me, obviously.
Yeah, obviously.
But I don't have the processing skills to support it, but I still have the interest.
For sure. Yeah. And I love all the stuff that you're doing. And I knew that you had that passion for financial literacy. And I wish we had more people that would do that. Now, obviously, you were connected to schools. So maybe that was a little bit easier for you to get into schools. Because I hear some people saying it's kind of hard to, even if you volunteer to go into the school, sometimes it's kind of, well, I guess, what do you recommend for someone that's like, well, I like what Jeff is saying, and I've learned a lot of things that I would love to go share with high school students. How would they go about that?
Well, the first thing they'd have to do is they have to take care of themselves first. Just like when you're in an airliner, you and I are flying somewhere and heaven forbids a bird gets sucked into the turbine and with the air mask drop down. I'm sorry, Jackie, I'm putting mine on first. Then I'm going to help you put yours on. Back to your question. The person needs to become literate and have merit in whatever they're going to teach. And the one instructor here in Reading said, "How much do you charge?" I said, "I don't charge nothing."
Yeah.
He goes, "Really?" I said, "All I need you to do is put this up on your screen because I am not techno in that world." And I said, "I'll take your classes." He goes, "Can you do 4 back-to-back 50-minute ones?" I said, "Hey, I drove twice to Chico, California to go to PV and did their block schedules, did one on one day, drove home, did some fishing, drove back the next morning and did the next one because I wanted to have that hour and 40 minutes with them, or 130, hour and 36 minutes. So only way I can do that is I've taken care of myself so well. Then I can extend myself to others, just like you and Bill are doing.
Yeah. And with my intro, I said all that. I wanted to be the one to say it because it's so impressive. But I know you really don't have an interest in blasting that or highlighting that, except to use as an example, hopefully to inspire and to say, hey, this can be done by the average person.
You can. You're going to have to do some potential. If you got lower income, you're going to have to do some extreme behaviors or up that income, because it's your income that will determine whatever wealth level you have. If I had gotten a higher paying job earlier, or maybe started investing in the 1980s, it might have been more. But when do you reach the point when enough is enough? I could have stayed at school. I could be making $25 an hour more. But think of all the great experiences. I would have never met you. Now I've met Bill. I've been on podcasts. I've been able to go to schools. And everybody's got their own path.
Yeah, that's a rich life. I mean, so I love what you're doing now. So you are living off of your pension. And are you eligible for Social Security? Will you be able to get that, 62 plus? Okay, you're eligible for Social Security?
Yeah, I'm eligible for Social Security. My strategy is I changed to Medicare, right? Mm-hmm. And right now I've calculated I'll take about $150,000 worth of advanced premium tax credits, depending on the laws, keep my income low when I get onto Medicare, because if you earn a certain amount, you have to pay back the government. It's like a tax. That's how they got it in there.
Is that the IRMA? Yeah, that's the IRMA.
I don't know. No, it's not the IRMA. That's for Medicare. Sorry. I'm talking about for the advanced premium tax credits.
Oh, yes, for the tax credit. Okay, I got you.
When I received that inheritance in 2021, that $80,000 rolled onto my taxes and my pension. It shot me to like $130,000.
Yeah.
They had given me about $11,000 if it wasn't for the American Rescue Plan that put more money into it because there was a cliff. If you went over $1, Jeff, you give them $11,000 for the whole thing disappeared. So I had to pay $1,800. So my goal is once I get to Medicare, I will start pulling some money out of the IRA. I know everybody's saying Roth conversions. I've been a low taxpayer all my life. If in the last 15, 20 years of my life, I'm paying 25 or 30% or 7 or 8 to the state, it's okay.
So Jeff, do you have any of the money in your IRAs or any dollars in a Roth account?
No, I did not do Roths. Unfortunately, I emptied out my Roth to buy my house.
Okay, gotcha.
That could be a no-no. I don't believe they're going to keep the Roths. It wasn't until 2010, if you were a certain income, you couldn't do conversions. Now, everybody and their brother, if I hear another Roth conversion story, I'm going to turn gray.
Right. And Roths aren't for everybody. Again, you got to look at your own situation. It's a great tool. You got to use it in the right way.
You got it. And to me, if I don't use all my IRA, it goes to charity. Or I can do a QCD with it or whatever.
Or you can donate it to the Catching Up to Five. No, just kidding.
There you go.
Maybe by then you guys will be past me. But what I'm going to do is once I get to age 65 or I'm off the Affordable Care Act, I'll move on to Medicare. And I've already calculated that's going to be about $400 or $500 a month because you got to get the Plan D, you got to get the B, you got to pay for your B, you got to get a supplemental. I'm paying for vision and dental out of my pocket because I want to keep my eyes and teeth good. And my house will be paid off. I'll take some money out of the IRA because I know everyone says, your IRA is a tax bomb. Well, if you looked at my net wealth, it's almost more or exceed my lifetime earnings.
Yeah. So, you're not worried about that. You're comfortable. You're happy. You're doing what you love.
I'm waiting until I'm 70 to take it. It'll be about $3,000 a month. Who knows? Maybe they'll means test me. Oh, well, penalize me because penalize me for being a good investor / saver. So I'm good. I beat the game. There's a word. There's a baseball term I learned probably from my dad. It's called the catbird seat. Means to be in an enviable point in life. I have choices. I have freedom. That's beautiful. We are super excited for one of our new partners. It's called Create Your Own Financial Plan. And this is a comprehensive video course by our friend Cody Garrett. He's with Measure Twice Money, and he's been on our podcast. And we love this course that he has put out. So if you are a true do-it-yourselfer and you've been wanting to put together a financial plan, check him out. I've gone through the course myself, and I have nothing but praise for it and the quality of work that Cody Garrett does. Cody Garrett is a CFP, so you're getting the mind and the experience of a CFP that you can trust. You just need to go to measuretwicemoney.com/catching up, and you will get $100 off this course. And again, that is Measure Twice Money Catching Up.
You did make mistakes. You talked about the annuities. You talked about selling out your Roth. We learned from our mistakes. Were there any other big ones that you want to share with our audience?
Not upping my income and not embracing my blue collar skills.
Up in your income.
Yeah, up in your income. When I talk to one person I'm mentoring, she's a young person. You go listen to her podcast, Custodian Turns Accountant. I said, if there's a partner in your life, depending on your gender preference, they're a bonus, but don't count on them. And I said, you have to take care of yourself. That is one thing. My dad's got some issues, but he always said, Jeff, I want you to be able to take care of yourself wherever you're at in your life. Whatever happens to you. First wife says, you're not so hot twice. I'm back up and going to buying a house. My one friend goes laughing at me on the phone one time. We're talking. He goes, you're right back where you started in your bedroom. I said, I'm not here for long, buddy.
So Jeff, I know you talked about mentoring and you just mentioned the custodian that turned accountant. So we love that you mentor. Can you tell us about that? We'll put a link in the show notes, but tell us about that young accountant or that young custodian turned accountant that you mentored.
Yeah, we kind of met surreptitiously when one time I was working between Pacheco and another school district because I just took on a house and I'm trying to renovate it. And anyways, long story short, one of the custodians that was my lead custodian had another custodian. This is about 2 years ago, said, hey, one of my custodians wants to learn about personal finance. And she's young and she's single and she's still living at home. Okay. And you can go listen to the podcast. So her and I got hooked up and she calls me her financial dad. And we both can connect because we both come from low social economic standard. And she had a certain way of looking at life, kind of small and narrow. And she is moving ahead in life. And we meet once a month. Sometimes we talk for an hour. Sometimes we talk 2 hours. Sometimes we talk 3 hours. The only thing I ask Miss Small to do is do the behavior. If we sit like Bill gives them a prescription or gives his clients some exercises to do, if they don't do it, then why waste his time and her? That's how I treat the people I mentor. And they're both women and they're both single. That's one thing I appreciate about women. Most of the time they want to learn. No offense to the men that I hang out with. A lot of times, even myself, they don't want to learn or take lessons from others. Does that make sense?
Well, they sure are lucky to have you in their life as a mentor.
I'm lucky to have them. I don't have any family. I don't have kids. I don't have interaction. If you're not using it, you're going to lose it. And I think Bill can attest to that in his industry. Because if you're not getting stimulated, I think I get more out of it than they do.
Well, you're a curious person, and curiosity, fitness, fiscally and physically, probably drive the bus. And I think also dogs. We have dogs, and I'll live longer because of the dogs.
And you have a spouse too.
Yeah, that's true. That'll work for me.
That works. So I'm hoping that I can maybe get up to 10 people I mentor. And I try to tell them that it's not a one-time done and thing. I go, this is a long-term commitment. I said, if you get to the point where I'm not providing you value or I'm not, or vice versa, we go our separate ways and we move on.
Wow. So, Jeff, I know you've primarily been a do-it-yourselfer, as many of us are, but I saw you recently were interested in using a service, the Nectarine, which is brand new, but we know Jeremy, who does Personal Finance Club, but he started this out. So have you used any of the planners on Nectarine yet?
I am going to do that. I am going to do it. Yeah. For 150 bucks, that's like dirt cheap.
Yeah. And you get an hour.
Yeah. You can do an hour, 2 hour, 1 time, 3 times. I'm going to try 2 hours because I want somebody from the outside to look in, because sometimes even myself, you can get very myopic, very narrow. You can't see. I know what they're going to say, do Roth conversions. And I'm like, but I want them to look at what I'm doing and give me their opinion.
Yeah. And listen to you,
Yeah. And I want someone to look at it. I mean, and get their opinion. And I am going to use them this year. And I've recommended them to a person that I mentor, because I said, I'm not the Holy Grail. And I said, you need to have someone else looking at this stuff too.
So prior to Nectarine coming along, and I'm a big fan of their model as well. And we had Jeremy on the show, the founder. So you never attempted to use a financial planner prior to searching someone out on Nectarine? Did you ever use a professional before?
No, because I hate to say this, I reached a level where I know as much as they do.
And I can attest to that. You do.
I don't brag very often. I don't ever say braggadocious, but I did look for one firm because I followed those two guys. They're about Bill and our age, and they have, 170 offices. And I was interviewing one of their CFPs, and I asked him, I said, I think my portfolio was like 700,000 in, or I don't know, whatever it was, investable, 600. And I said, what's the fee? And I think it was like, I don't know, I can't remember the percentage. I said, could you convert that to a dollar amount? He goes, yeah, that's going to be about $9,000 a quarter.
What? That's crazy.
That's what he said.
And what did you say? Okay, Jeff is no nonsense. What did you say to the guy when he told you that?
I said, do you know what the opportunity cost is on that $9,000 being taken out every quarter? Can I pay it directly to you? He goes, we've never had anybody ask us that before. I'm not putting them down because the two guys that run the investment firm has to pay all these people, and his family gets to go places, and we're a capitalistic society marketed to all the time.
Yeah.
And I'm a little pipsqueak because the people I listen to on their podcast say, oh, we got 10 million there, or we sold a business, or we're a highly compensated medical professional, or I own a couple of clinics or something. You know, I
Right.
technically shouldn't there. So I'm not putting them down, but I didn't want to see $27,000 taken out of the account
Heck no.
or whatever it would have been. Yeah.
Yeah, it would be 9,000. 9 times 4 is what, Bill? You're the smart one.
36.
A lot.
36. 9 times 4 is 36.
Well, it's more than his annual spending. I mean, what the heck?
Yeah.
Yeah. Do you see the disconnect? Did you see the disconnect? It's more than my housing costs. It's because I'm unusual. I shouldn't be here.
Mhm. When you said $9,000, I thought you was going to say 9,000 a year, but you're saying 9,000 a quarter.
A quarter, and that wasn't the underlying investments. I'm not putting them down.
Right. There's so many different approaches now. So Nectarine attracted you.
Yeah, because one, it's an opportunity to, there's different levels of wealth and different levels of services. I mean, if you got 10 million and you're going to do some advanced estate planning and some sophisticated stuff, but the vast majority of people don't fall into that. What's it? 56% of the people can't come up with $1,000.
Right.
I'm not throwing dirt on everybody, but that's why I like Nectarine's platform, is because their business model is, I hope it grows.
Interesting. And I'm hoping that finally more people will be able to get planning services because of that platform. So I'm encouraged, and I think it's going to serve a lot of people.
To get perspective, I mean,
Yeah.
the average fees out there, well, I don't know if it's an average, but the range is $300 to $800 an hour. You know, Nectarine is bargain basement cheap. How could you not do it? I mean, Jeremy's gonna have to listen to this show. We've tooted his horn so much.
I know. We just organically appreciate that type of approach. So Jeff, obviously you've learned a lot. You talked about the community college, which is really helpful. What other resources? I don't know, podcasts. I know you listen to podcasts, books, YouTube. What are the other really good resources that helped you and you would recommend to others?
Well, I was listening to podcasts all the way back in 2005 when you had to pay $1,800 for an iMac. So podcasts for me has been the replacement of going to college for 15 years, taking a class at a time. Other resources is search out a mentor. My dad was a mentor to a certain level, but if I had somebody had taken me under their wing and told me about how to do personal finance and investing and those things, it would have changed everything. Another resource, go to your public library. There are so many books here to read. I'm from the old school where I like to read a book and actually hold it in my hand. But you got, for the next generations in the technology, you got podcasts, you got YouTube video, but you have to be careful out there because there's a lot of misinformation that you have to sift through to find the nuggets. And that's why I'm on this podcast, because this is like a pot of gold to me. And maybe I'm biased, but that's why I'm putting 2 hours of my effort on this podcast, because it allows people to have a reliable, honest source of personal finance and information from people of diverse backgrounds. And you can get there. It's a choice. Yeah, I know you're going to have circumstances and stuff, but that's why I'm on this podcast. I'd use this podcast.
Well, I think hearing from different people and different stories, and yours is just so inspiring. I really wanted to share you with our listeners, our community, and we try to give them all kinds of different backgrounds and different people's journeys. Those are so important. And you just knocked it out of the park with your story and your journey. And I'm still in awe when I'm listening to you.
Yeah, I mean, you know, I don't mean to throw dirt on me, but one of the animals in the animal kingdom, I'm like watching Channel 9 one night, they had baboons on. A baboon only takes, out of its 24-hour period, I know this is my weird science side, it only takes 3 hours out of its day to get it enough nourishment and to keep it sustained. That's how I am in our society. And then the rest of the time, I can go do what I want. Yeah. And that's priceless to me. So that's what I would want to leave your listeners with. Assess your life. Is it serving you? Or, are you serving it? Does it own you? Do you own it? Does that make
Yeah.
sense? And that's kind of where I'd like to just leave it at, is just, you can do it. Just educate. And that's what you and Bill are doing. It's wonderful.
Well, we really appreciate your time today. I mean, there's been so much value here, and we could dive into any one of these topics a lot. I think our Catching Up to FI audience will be interestingly piqued in your story and a lot of the things we've talked about today. We like to close with, and you may have already said it, but let's reiterate, what maybe top 3 tips do you have for our late starter audience?
Get educated. Educate, educate, educate. Learn the tools to get you to your goals. The second thing is, first, get your own personal financial life in order. If you have somebody that's not on the same team, you need to confront them and get them on the same team. That would be the second thing. The third thing, get your health together. Because once you reach financial independence, you want the health there to enjoy it. So I know of so many people in my neighborhood, because it's kind of an elderly neighborhood. I'm elderly now. I see people with health issues that when you reach financial independence, your biggest thing in your life is, no offense, going to see the medical profession. So those would be the 3 things. Get educated, get your health under control, and get your own personal finance in house, and get a plan, write it down, memorialize it. So that's kind of how those would be the 3 things that I would look at, That's my opinion.
Those are all great tips. And Jeff, it's been an absolute joy having you today. So thank you so much for being so transparent. It's just been a powerful conversation. We've talked a lot, but I've gotten so much out of listening to you today. And I know our listeners did too. So I'm just glad you stopped by. And, we love you here at Catching Up to FI. And thank you for sharing your story with us.
Thank you very much. You have a great day.
I look forward to meeting you in person.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. So our social media is Diana Falk, our editor Fritz Bassard, and show notes are done by Sarah von Sternberg. We love them and they keep us going.
Yeah, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community and we hope you love us back. If you want to support the show and what we're doing, you can do that at Buy Me a Coffee, which is a platform that allows you to virtually say thank you if you get value from our content. The link is in the show notes, or you can head over to our website at catchinguptofi.com and click on the Support the Podcast tab at the top right. We hope you've enjoyed this episode of Catching Up to FI. We would appreciate it if you could leave us a 5-star review so that our message can reach others.
While we are financial educators, and I'm a financial professional that loves to teach, our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
We'll see you next time on Catching Up to FI.